Good morning, Axie Traders. I'm Greg McKenna. Welcome to Markets Morning. It's the 3rd of March 2017. It's been a massive night for the Aussie and Kiwi dollar as the US dollar strengthened and markets moved to reprice even higher the chances of a Fed rate hike on the 15th of March. That's because the Fed, again, even the doves, are signalling that the time is nigh for the Fed to get busy. Now, that's something that I've been talking about for a while now. You've got to listen to what Fed speakers say. I know that in 2015 and I know that in 2016 they promised a lot and delivered little. There were excuses. It was still unsure whether the US economy was on a firm footing. By waiting till now, they've allowed it to get clear air. They've allowed inflation in a core sense and in other sense to get above 2%. They've allowed the labour market to tighten even further. And last night we saw jobless claims, another drop of 19,000. 19,000, folks. That took jobless claims to the lowest since March 1973, 44 years ago. Think about how big the US economy was. Think about how big the US labour market was then compared to now, and you get a sense of how tight the market has become. Now, how's that manifested? If we have a look here at this FedWatch tool from the CME, this is where they use implied pricing in futures markets to work out what the market is guessing or guesstimating are the chances of a Fed rate hike. Just last Friday, 25%. Monday, 35% roughly. You'll recall I wrote about the 9% increase. What have we got today? We've got just under 80%. That's a full 50% move roughly. More actually, from where we were last week. Why is that? Because consistently Fed speakers have all been on task. The time for a rate cut is here. The message has just been so clear. Even Lael Brainard, who is a Fed governor, said yesterday that the time was nigh. Specifically, she quoted, where the economy is in employment, where the global economy is, that other countries are on a more solid footing. Have a look at my overnight wrap. You'll get more details there. Jerome Powell repeated that the time was nigh, and so what we've got is we've got a much stronger US dollar. We can see if we look at the US dollar that ghost pattern, that head and shoulders, hasn't worked out yet. Something could happen. They may not deliver and we'd see the US dollar weaker. But overall, it respected that support in the 99 figure 50 region that we talked about a couple of weeks back. It's been rising. It's broken 102, which was one of the preconditions we talked about a week or so ago that it needed to. Probably 2 weeks ago, it had that failure at 101.90. It's gone higher now. Don't underestimate the importance of this utter recalibration of expectations. Just a week or two ago, the market was thinking, the Fed might go twice. Now the chances of them going 3 times have to increase materially. Why do they want to hike in March? I think it's almost a lock. And you recall earlier this week I was saying it's 60-40. It's got to be sort of 80-20, something like that. You don't want to go too much past 80-20 because non-farm payrolls next week could be awful. Stocks could do something, but it's as close to a lock as you can get based on what they've said. And this is important, because now there's a chance. What the Fed's doing is making room for itself to not do anything. Now, I know that sounds counterintuitive, but this is exactly what they're doing. They go in March, and they've got 9 months, not 9 meetings, but 9 months. They've got 9 months to do the 2 more that they think are appropriate, or they thought in December were appropriate. That's important. If they don't go now, there's no press conference in May. Suddenly we're in June, and they might have to go bang, bang, bang. That's what they don't want to do. They don't want to go bang, bang, bang. They don't want to make the same mistake Japan made years ago with that sales tax. You'd think a tiny little sales tax increase wouldn't hurt the Japanese economy. Dun-dun, falls back in a hole, back into deflation. The Fed wants to gradually increase interest rates to levels that reflect the current economic outcomes. Inflation where it is. The jobs market where it is. Then, that's even before you throw Trumponomics on top. Now, you remember last December I was saying 4 rate hikes this year? I still think that's a chance, but we're certainly going to get 3, pardon me, unless this US economy goes off the rails. Excuse me. So what does it mean? It means the Aussie got hammered. I've done a special Aussie piece as usual. Yesterday afternoon, after we had that disappointing but still good surplus in trade data, The Aussie traded under 50, and I tweeted that it looked a bit wobbly. Looked a bit tired, I think was the exact words I used. We're now down. My target was this bar here, basically from the 2nd of February, where the Aussie accelerated up from 75.77, I think it was. So we've satisfied that. 50% of my short is now off, and we'll see how we're going. 75 figure 12 is the garden variety 38.2% retracement of this 2017 rally. That should be reasonable. Doesn't mean we get it today. Doesn't mean we get it tonight. We could do. Below that, 74.5 and then 73.80 are the two levels. If you have a look at the 77 region, whenever there's been a decent pullback from 77 cents over the last 10 or 11 months, it's been between 200 and 600 points. What does that mean? Does it mean anything? Not really. It's just kind of the average pullback. But it does tell you that expectations got too high, too far, and then the market has to unwind. So how would you characterise Aussie? It's been in a big old range. But have a look at my Aussie piece on the blog. There's a few more details there. What else is going on? Well, naturally, the euro's under pressure. Sorry about that. It's slipping. You'd have to say there's a real chance at 105 now. Janet Yellen speaks tonight. Stanley Fischer speaks tonight. A few other Fed governors. A break of 104, let's call it 80. Break of 104.80, and I'm going to start talking about a round trip back here to 103 low, something like that. We'll have to wait and see on that one. But it does look like the bears are in control of the euro. Now, the euro, in fact, though, should outpoint the yen and some other currencies, because even though Mario Draghi and his board, are resisting, the need or potential to change interest rates, what we saw in EU inflation last night was an uptick to 2%. Job done, boys. Now, of course, Draghi said he'll look through that, so let's wait and see. But there is a chance that Europe does have to recalibrate its monetary policy later this year. That's not going to help for now, but I think it can help euro outperform on some of the euro crosses. Sterling, I think sterling continues to slip. I put a piece out yesterday identifying a test down towards this support zone, 121, something like that, is my target. Dollar yen really hasn't even got busy yet, has it? Hasn't even taken out the high from a couple of weeks back, which would suggest 115. I think dollar yen gets through 115, it goes 118 pretty quickly. It's really interesting that the dollar has been less aggressively bought. Now, what does that reflect? It reflects that it's a crowded trade. We know it's a crowded trade. It's probably the most crowded trade on the planet, but it's the right trade if the Fed is going to jack up rates. So probably, between now and the 15th meeting, we can probably continue to see the US dollar bid, and there's chance for some disappointment in the signalling that the Fed does on March the 15th. If we have a look at some of the other markets I cover each morning, WTI, just like the Aussie, can't go up. Well, let's sell it. That's what traders do. I know it sounds trite, but that's how markets work. If you can't get up through a level, what do? You pull back. That's the way they work. If you can't get down through a level, what do? You rally. That's how they work. Simple stuff. There's some really simple heuristics that you can use in trading. Trend lines, things like that. You can't get through a level, it's going to pull back. It's going to look for support, that kind of thing. But what's the fundamental driver behind oil last night? Novak, who's the Russian energy minister, said that it's too early to talk about an extension of the crude oil production cut that OPEC and non-OPEC have agreed. We also saw from the EIA shale oil production in the US increased last month. Don't forget, earlier this week I quoted a report via Reuters that said that the break-even curve for shale oil producers has materially dropped over the last couple of years. You'll recall I talked about, I think it was a BP, some Canadian production at $60 a barrel. They couldn't. That was their break even back in 2014 when they decided not to. They're now starting to. Its break even is below $40. Likewise, I think it was Shell, a deep water well in the Gulf of Mexico for the first time in a couple of years. Production technology is making extraction so much cheaper. We've seen it in iron ore. We've seen it with the Australian miners. Their cost curve has materially dropped. They're making more money. And so that has impact on the efficacy of OPEC and the production stats of US. Keep an eye on that as we go through the year in case US production materially increases. I've got my focus now back on this $50, 50-50 region for WTI, and then I'll see. Outside chance, I think, that we can go under $50. Looking at gold, we've broken down. I've just done a special piece on gold. If you recall, I called it the other day when it couldn't sustain above the 200-day. Said it looked like a top. That's what we've seen. Gold looks like it's going to go down to the 12.12 to 12.19.20 region. That's the garden variety, 38.2% retracement. We'll see how it looks there. US dollar and US interest rates weighing on that, but have a look at the piece I've written. S&P pulled up where it should. This is our old trend line, goes back to 2011. What can I say? I think this is the top. Is it a sell? For me, yes. I was long Aussie stocks back on the 21st, 22nd. I've been out for a week or two. Yesterday's performance on the Aussie market was disappointing in a price action type. Look at that. This is what we've got. That's the 4 hours. Last 4 hours have been pretty ordinary for the local market. A big reversal. If I blow that up so you can see it properly, I apologise. That's an ugly pin bar, isn't it? We've got SPY down 26 points from yesterday afternoon. So that, to me, if you drop back to the 4-hour charts, looks pretty poor, and probably a run down to the low 5700s today. Last but not least, copper, because I know I'm running out of time. It's 11 and a half minutes. I do apologise. Copper's down last night. US dollar stronger. What can I say? Watch out for Yellen Fisher et al. Tonight. It's going to be a big one, but have a great weekend. I know it's going to be a wet one on the East Coast here. Hopefully I can still get a surf in. Hope you do too. It's the best antidote for the kind of stress that some people feel in trading in the world. I know some people like to fish. I like to surf. But have a great weekend. Bye for now.